Man, as I was up there in Mexico, I'm just watching, news stories that I would like to be doing, emailing myself, do this one, do that one, do this one, do that one. I normally don't do videos even on Sunday, for the most part, very rarely. And I've just set myself, do this one, do this one, do this one. So it's like, okay, I'm going to have to upload 2 videos Saturday and 2 videos potentially Sunday just to catch back up to where I need to be. So here's essentially 2 in 1. The next banking crisis, or scandal technically speaking, explodes in Spain. When's the last time we heard of Spain with its 21% unemployment rate? And other countries are cooking the books like we do, like our government, 5% unemployment, have the worst jobs print ever, or at least in the last 6 years. The other day, markets didn't like that. Gold and silver jumped heavily, etc. But do you think it's, is it really 21.4%? Or is it even worse? Chances are it's worse. It's not better. But even if it's accurate at 21%, 1 out of 5 people don't have a job. And I remember a few years ago, Spain, after the 2008 problems, right? Spain was in the spotlight. 2010, 2011, Spain, Portugal, there's a few countries that kept coming up. In Spain, I mentioned this then, Spain is a big, big economy. It's not a little old Greece or anything like that. So they've got 21% unemployment, and now there's a banking scandal that has now erupted. Quick look surprised. And on top of that, speaking of Deutsche Bank from my other video, whistleblower said to aid Security and Exchange Commission in Deutsche Bank bond probe. You're going to get used to hearing fraud, cooking the big books, accounting errors, accounting manipulation. You're going to hear this as the economy really starts to tank worldwide. You are going to hear this story from just about every financial institution, bank, too big to fail, any of them. You're going to hear this over and over again. They had this many assets on paper, but then we looked, it actually didn't have that, and what they were calling assets were actually not. These were liabilities, and this was that, and they marked these bonds way too high. And as Cliff High said, Webbot report, and keep in mind, when we had a whole bunch of bankers dying off, one was suicided, one ran his car off a cliff, one was on a bike, fell over a cliff, one jumped off the top of a building. There was at least 20-something, maybe up to 30, by the time those news stories finally stopped coming of these alleged suicides. He said in the latest report, get ready for that again in the not-so-distant future. Next banking scandal explodes in Spain, Zero Hedge. The last 5 years have been a bumper period for banking scams and scandals in crisis-ridden Spain. From Bankia's doom IPO in the 2012 to the mis-selling of complex Preferentes shares to unsophisticated retail bank customers, including children and Alzheimer's sufferers, all of the scandals have had one thing in common. The banks have consistently and ruthlessly sacrificed the welfare and the wealth of customers, investors, and taxpayers on the altar of short-term survival. Some commentators claim that the problem of banking instability in Spain has been put to rest in recent times, thanks chiefly to a robust debt-fueled recovery, a tepid resurgence of the real estate sector, and the transfer of the most toxic assets from the bank's balance sheets to the festering balance sheets of the nation's bad bank known as Sareb. These could not be more wrong. Despite the untold billions of euros of public funds lavished on cleaning up their balance sheets and the roughly 240 billion euros of provisions booked against bad debt since December 2007, the banks are just as weak and disaster-prone as they were 4+ years ago. And now it seems a new scandal is in the works. Last month, Spain's 6th largest financial institution, Banco Popular, announced that it was urgently seeking to raise 2.5 billion euros in capital in a desperate bid to shore up its finances. The news triggered a sell-off that wiped out 33% of the bank's market capitalization in just 2 days, before investor nerves were steadied somewhat by revelations that the bank had found 10 global megabanks as underwriters for its 2.5 billion euro rights issue, including Goldman Sachs, Morgan Stanley, Santander, Deutsche Bank, and HSBC. Wow, the too big to fail club. But in recent days, the stock has once again begun to crumble, following allegations that Popular is also doing some creative selling of its own. The Spanish investment group Brickbird claims that the bank is offering customers dirt cheap loans or refinancing deals at an interest rate of just 2.5% as long as they use some of the funds to purchase the bank's new shares. Almost sounds like a Ponzi scheme, doesn't it? Pyramid/Ponzi scheme. Popular is offering loans to its customers on the condition that they subscribe to the rights issue and then deposit the $1.25 per share in their bank accounts, asserts Mark Ribes, co-founder of Blackbird. If Blackbird's allegations are well-founded, and so far there's been no official denial, Popular is in the process of taking the dark art of banking misdeeds to a whole new level. In the Preferentes scandal, Spanish banks effectively plundered billions of euros of their customers' savings to keep their balance sheets intact. This is the same thing, almost the same thing, as John Corzine, MF Global. All these people, like Gerald Celente had no idea he was part of their system, but was using another broker who used MF Global, who then used JP Morgan as the chain of command, if you will, goes for buying and selling online. Now, the company that Gerald Celente was using, nobody knew they were using MF Global, who was using JP Morgan or anyone else. You just think, I'm using this brokerage firm, and that's it. And it turns out that it was really MF Global. And everybody who was using MF Global had allocated accounts, which again are accounts that are as good as a safety deposit box. You're the only one with the key, sir. No one has access to this but you. But online. Put my money in my account, I log into my account, I see what's in there. Nobody is touching that money unless I do it or I put a trade out or whatever. Then it goes in to wherever I put it. And they found out MF Global was taking its customers' money to kind of shore up its books when it made bets. See, MF Global took the money and was making bets because you're a company and you've got a bunch of clients and their money, it's just a computer screen. It tells them how much is in their account. But ultimately, it's how much you as the company have in its entirety, including all the customers. So you're realizing we could take, as long as the numbers, when someone logs in, are there, we can take the money and bet really quickly with a huge amount of money, because we're not using our company money, we're using the money of these customers. Very quickly, we'll use it, make a bet made a good move in European bonds or whatever stock, boom, take the money back out, we just made a huge profit. But you didn't share that profit with the customers who have their allocated account. They don't even know you're doing that, and it's illegal. But the amount of money I could get and play with by just quickly taking their money, bet over here, put it back, and then I reap the profits off the top for my own company. Who's going to know any different? Well, he made bets, and the bets were wrong, and he got cleaned out. Instantaneous bankruptcy. And then he quits or whatever, and the Congress, they have this little nonsense committee. Can you tell us, sir, Mr. Corzine, such and such, well, I would really like to help you. I would really like to get that information for you, but I no longer work for the company. And because of so, I don't have access to that type of information anymore. You would have thought this guy would be doing some serious prison time. Nope. Just type in Google images, John Corzine, and you'll find plenty of him standing next to Barack Obama, cheering, waving, hey. Because he funded or gave some pretty nice campaign contributions to Mr. Obama. And this man never saw a day of jail. Nothing. So that's essentially kind of what this bank is trying to do. We want you to buy these bonds or these shares. What is this? We want you. Popular is offering loans to its customers on the condition that they subscribe to the rights issue and then deposit the $1.25 per share in their bank accounts. That's a wave of a bank waving a red flag at you saying, do not come over here, don't you dare, you're going to be in big, big trouble. Except when you look at the flag, it actually kind of looks like this one. Oh, America, solid. I'll invest in anything. It's backed by the full faith and credit of such and such government. And if their faith and credit is zero, garbage, negative F rating, then what? Then you better hope you had been investing in precious metals this whole time. The chances of this. So here we go. Let me finish this. If Blackbird's allegations are well founded, and so far there's been no official denial. I already read that part. Let me move on. In the last 5 years, Spanish banks have been able to bend or break just about every rule in the book, with not so much as a slap on the wrist from Spain's two biggest financial regulators, the CNMV and Banco de España, both of whom have been accused of a raft of oversight failures in Bankia's IPO. Quick look surprised. That's kind of like the FDA approving something that kills people. Even on the bottle says this may kill you, may cause suicidal thoughts, may make yourself jump off a building if you're a banker. Premature kidney failure. And then the lawsuits fly. Okay, we got to take that drug off the market after reaping billions in profit. This was FDA approved, right? Just like this. This is the Spain's two biggest financial regulators approved. The chances of the same two regulators suddenly taking an interest in the misdeeds of one of Spain's biggest financial institutions are paper thin. As for Spain's caretaker government, it's not hard to fathom where its loyalties lie, particularly in light of the fact that the governing People's Party just received a $1.2 million loan from Banco Popular so that it could post bail for 3 former treasurers accused of operating a multi-decade slush fund to channel corporate kickbacks to senior party officials. Meanwhile, Spain's fourth biggest party, the center-right, financed its last election campaign with a $4 million loan from, yes, you guessed it, Banco Popular. With 10 of the world's biggest and most deviant banks preparing the ground for Popular's capital expansion, while Spain's regulators and government look the other way, it's hard to shake the feeling that a trap is being laid. If the last 5 years are any indication, the chosen prey will be, in order of appearance, gullible customers, retail shareholders, and Spain's unconsulted taxpayers. Once again, the wealth of the country will be redistributed from middle-class taxpayers, investors, savers, and pensioners to the executives and creditors of financial institutions. As a former Barcelona-based banker told me a couple of days ago, quote, the banking sector, once the foundation of the economic system, is a disgrace. It has lost all sense of purpose, apart from sucking dry what little marrow remains in the productive economy. Things have gotten so bad in the Eurozone that even the staunchest Eurocrats are beginning to express doubts. Even European Parliament chief Martin Schulz, who warned over a possible implosion of the EU, but now the Eurocrats are not just falling into despondency and despair, they're beginning to turn on each other. I'm going to go ahead and finish this up with the Deutsche Bank probe. Whistleblower said to aid Security and Exchange Commission and Deutsche Bank bond probe. Bloomberg. The U.S. Securities and Exchange Commission is being helped by a whistleblower in an investigation of Deutsche Bank AG's post-crisis mortgage trading business, according to people with knowledge of the situation. The Securities and Exchange Commission received a whistleblower complaint alleging that the bank inflated, cook the books, the value of mortgage bonds on its books and masked losses around 2013, said the people who asked not to be identified because the matter is confidential. The Securities and Exchange Commission is probing how the bank valued government-backed mortgage bonds, known as agency pass-through securities, that it amassed over the 2007 U.S. housing crisis. Investigators are looking at positions overseen by Troy Dixon, who ran the bank's trading for U.S. government-backed mortgage bonds after the crisis until he left the bank in October 2013. Security Exchange investigators want to know whether the bank delayed recording losses over an extended period of time on pass-through securities with high coupons, the people said. Judith Burns, a Security Exchange person spokeswoman, declined to comment. That's because, Judith Burns, I'm sure you want to go work for one of these banks at the next possible availability that since you're going to look the other way and we investigate, but we really didn't see anything. That way the open door is there for you to go take a high salary by doing your job, which is not doing your job because I want to go work for a bank. That's probably how that's going to go, unless, as we've been discussing over the past month and a half, is Deutsche Bank the fall guy for everything that's about to go down. And if that's the case, then the Security and Exchange Commission will actually do something against them. So if they do, then you will just know, nothing new here, nothing to get excited about, like they're going to go after all the banks now. No, they're going after the fall guy because it's the fall guy. All eyes on Deutsche Bank, they're the bad guys. JP Morgan's fine. Goldman Sachs especially, Vampire Squid, fine. Bank of America, fine. Spanish banks, those are fine and fine. Right. Deutsche Bank's losses for agency pass-through securities surged to 394 million euros for the whole of 2013, or more than $500 million at that time, according to trading documents seen by Bloomberg. A spokesperson for Deutsche Bank declined to comment and instead referred to a statement that the bank provided Bloomberg last month that said it was cooperating with the Securities Exchange Commission investigation. In that statement, she said losses tied to the mortgage bonds have been recognized by the bank, without saying when the losses were reported. In other words, like right now, because we're going to go down with the ship and we're the fall guy, just now we recorded them and we're ready to show it to you. But we're not going to show it to you yet until some other things start to happen, because we're on a kind of an agenda to implode, but we can't release information until it's ready, all of which is going to make us implode and someone else will implode and then someone else. But the club has told me it's not time yet, so please refer to the statement we gave Bloomberg. That's probably how that really should go. Whistleblowers with the Securities and Exchange Commission can receive rewards for their information ranging between 10% and 30% of the money the agency collects for sanctions over $1 million. Informants can be among the most powerful weapons in the law enforcement arsenal of the agency, according to the website for the Securities and Exchange Commission Whistleblower Office, assuming they listen to you and allow you to come forward, because most of the time they're going to say, look, we looked into it, we don't think there's anything here, have a nice day. Yeah, but I used to work there, I'm telling you, no, have a nice day. Oh, wait a minute. Oh, this is Deutsche Bank, the one that's going to take the fall? Okay, so we need to go ahead and do it this time? Okay, cut. All right, thanks. Sir, come on back. I misspoke. I misspoke. Remember that one? The politicians say something, you play it back to them? I didn't mean that. I misspoke. Sir, I just misspoke. Or I was just misspoken. Whatever you want to call it. Come on back. We're actually going to look into this case. But hold on. But I thought you didn't find anything. Everything was... Yeah, I was looking at... Think quick. I was looking at a different bank. I had a different screen up on my computer. It wasn't Deutsche Bank. It was HSBC. Come on back. Let's talk about that now, so you can get your little reward. That is how that's going to be. Deutsche Bank's chief executive officer, John Cryan, crying when I met you, and I'm crying now that I left you, last year announced his intention for the bank to completely exit the business of trading U.S. agency mortgage-backed securities. The German lender has been grappling with a number of legal and law enforcement challenges around the world since Cryan has vowed to resolve. The bank last year hired as its general counsel for the Americas a former official at the U.S. Department of Justice and attorney for former President Bill Clinton. Is that supposed to be a good thing or a bad thing? I guess we're going to find out. Take care.